Hi, Savajit Chatterjee and Rohan Singh, recording our Charts Are Fun weekly session. This is the week of July 1st. Today is July 5th. We're going to talk about this week in particular. From an economic data, we had the ISM manufacturing and the services PMI data. Both were quite weak, and the market is hence expecting perhaps there's going to be a dovish Fed and a good chance that the first rate cut would be in September and maybe another second cut later in the year. There's also unemployment data. The month of June came out today. The unemployment has gone up to 4.1, again validating markets' concerns that the economy is perhaps slowing down. They also brought down the jobs for the month of June was at 206,000, was above the expectation of 191. But the last couple of months, this has been a slowdown. So it was 218,000 jobs in May, and that came down to 206. But then for the month of May and April, there was about 111,000 jobs that were downward revised. So originally, May reported 272,000 jobs, but that turned out to be lowered down to 218. And April had 165,000 jobs that was lowered to 108,000. So market is expecting a dovish Fed, which, from an interest rate expectation means that a lower interest rate will help the growth companies, will help those that have to, raise capital to drive their growth. So, of course, the market has been climbing higher highs since the October lows. A lot of that is AI euphoria. We know that the Magnificent Five have been doing extremely well. So we're going to talk about how QQQ is headed. So we'll start with overall market as we talk about the core ETFs. We'll talk about the sectors. In particular, discretionary sector had an outstanding week. Tesla broke out, as we had stated in the past, had an amazing breakout. We had a target of Tesla near 259. It almost hit 252 today, and likely has some more upside to that target. There's also Amazon in the discretionary that is doing extremely well. And we're going to, talk about cryptos. This particular week, there was that fear of Mt. Gox liquidation. We'll talk more about that. And cryptos took quite a bit of hit this week. We'll see where Bitcoin is headed from the charts perspective. We'll look at small caps. We'll look at QQQ in particular. QQQ, we've been talking about a target near 520, so we'll see where it's currently headed. We are almost near 500. It tested 496 today, so we're not too far from that target near 520. And then look at 10-year yields. That's always a barometer of where the economy is. That's the 10-year treasury. We'll see where that's kind of looking at from a chart perspective, and that could perhaps have an indication of the market. If yields go higher, market usually doesn't like it. It could have a negative impact, especially small caps. So we'll end with the chart of Russell 2000 ETF IWM. With that, let me share my screen and start talking to some of the charts. So our Charts Are Fun YouTube channel is at Charts Are Fun. We encourage you to subscribe to our channel, and also if you like the videos, we can hit the like button. This helps us share the video with a bigger set of folks out there in YouTube. We also have our our blog site. We publish daily blogs. And usually it's about what's happening in the market, specific stocks, and so on. So in particular, we have a blog about the crypto. So that's something that you could take a look. And I'll touch more about that in the analysis today. A couple of blogs on crypto this week, one about Bitcoin and one about Core, one of the biggest miners in the crypto space, Mara. We can talk about that. And there were some other blogs on Gap and then the software sector breakout. So you could go take a look at that. It's at our substack.com, chartsarefun.substack.com. I appreciate if you subscribe to that as well. It's for free. Just put your email. As soon as the blog's published, you'll get a notification through your email. So want to talk about the core index ETFs. These are, the core, every index has an associated ETF with it. So these are sorted by the rate of change over 4 days, because the market had 4 trading days this week. Wednesday was a holiday, July 4th. So we are looking at the core ETFs. Actually, yesterday, Thursday, was a holiday, July 4th. We had 1 o'clock closure on the market on Wednesday, July 3rd, and then today the market is open full day. So if you look at the core sector ETFs and the core performances, the biggest movement from a rate of change was 7.26%. That was silver, the silver ETF SLV. NASDAQ 100 ETF QQQ had an awesome week as well, 3.56. Gold follows silver in very close fashion, especially when the dollar is weak. Precious metals tend to do well, and dollar was weak this week and got a pullback, and that helped silver and gold. So both did quite well. Gold at 2.74 GLD. Emerging markets also gets a benefit when dollar is weak. So the fact that UUP had pulled back from somewhere in the region of 29.2 to 28.9. So that pullback helped emerging markets ETF EM do well as well, 2.44. S&P 500's ETF SPY did 1.91. 10-year yields, we did get a pullback in yields this week. I'll talk about the TNX chart, and that helped TLT get a bit. So TLT was up 1.17. Diamond, which is the Dow Jones, industrial index, the 30 stocks in there, that was up 0.64. VIX did kind of have a downward slope, was up only 0.32%. We know that it has been steadily declining since the 20 plus that it hit closer towards the April lows, and since then it has come down, pulled below 12 in the 11s, and today again it slightly went above 12, but this week it had hit levels below 12 multiple times. The dollar was kind of weak this week, down almost 0.86%. And small caps, did not do well. This was, again, a clear divergence we've been seeing in the markets. It has just not been falling with the Magnificent Five, for that matter, the S&P 500 and QQQ, which are really weighted indices, weighted to the $1 trillion plus stocks. And we know that in particular, the Magnificent Five started with the largest Microsoft, second largest Apple, NVIDIA, number three, and then looking at Amazon, Google, and Meta. All of these have been doing outstanding well. And if any, Tesla from a Magnificent Seven was kind of lagging, but got a huge bid and had a massive breakout. In fact, from once Tesla broke out above 200, it ran all the way up to 252. So that's almost close to 20% plus gain, and 25% gain, and that happened just in a span of a couple of weeks. So that's just brilliant. And then we talked about cryptos being weak, in particular Bitcoin, Ethereum. They all had a pullback, and we can talk more about it. So GBTC, the largest crypto ETF, the Bitcoin ETF, performed poorly, was down 5.8% for this week. Looking at the sectors, again, the rate of change for 4 days. Discretionary XLY had the best week, gain for the week at 3.77. The technology, of course, helped by the Magnificent Six stocks, all doing very well, was up 2.94. Communication services, in particular, Google and Meta have been doing very well. Those are core large components of the communication services. Discretionary, of course, did outstanding well, especially after Tesla broke out above 200. Tesla and Amazon have over 35-40% of the discretionary's weight, and that has been helping, those climbs have been helping the discretionary. In particular, the XLY chart shows a beautiful breakout above 185 from a low near 168. So if you measure that, that's closer to 17 points added to 185. That can easily go to closer towards the 202 level. So it closed near 189. There's more upside on this, especially if Amazon keeps doing well. It should help the discretionary get a higher high. Technology has been climbing higher highs. However, we have seen the strength of the semiconductors taking a bit of a backseat, with the software stocks getting a lead. In particular, Microsoft, the leading software stock in the ETF, IGV, has been doing very well. And then some of the others like Salesforce and Adobe and some of the other big software stocks are also doing extremely well. Staples had a up 1.04% for the week. So the Procter & Gamble's, the Coca-Cola, Pepsi's have been getting a bit of a bid recently. Financials up 1%. Utilities up only 0.6, kind of lagging, as we can see clearly from the May highs. It has been kind of declining in a downward trend. So utilities not as such keeping up to the gains. If any, the strongest sectors that have been going really well since the call it the April lows, and then after the pullback in May, has been the discretionary. Technology, of course, is not looked back, a little bit of a pullback to its rising 20-day moving average, but again, resume its climb to higher highs. Communication, XLC, has also been extremely strong. Staples has been kind of range bound, but in many ways likely forming an ascending triangle, with the top of the ascending triangle at 78. The downward slope is towards 75. So that's a 3-point level. Add to 78 goes to 81. So there's a good chance that Staples might see a breakout above 78 and run to 81. And that might happen perhaps when we get a bit of a pullback in technology, because staples tend to be beneficiary of defensive money. So when growth stocks start pulling back, the staples tend to do well, being value oriented and being defensive in nature. Real estate, there is that concern about whether the Fed is going to be dovish when the first rate cut is going to happen. And real estate, as a result, has been kind of fluctuating back and forth. It had gone from 35 to 38.5, pulled back quite sharply to 36.5 when there was initially some, hawkishness from the Fed. Next week, a couple of things are going to happen. Of course, we had weak economic data this week, with the ISM manufacturing and services both being below 50, and also the jobs data with unemployment at 4.1. But next week, Jerome Powell will be at the Senate and Congress on Tuesday and Wednesday. And then we'll get the core CPI and PPI, the core inflation data, both for the consumer and the producer, on Thursday and Friday. So those data are all the market will be watching, and it could be interest rate sensitive, and that could have an impact on the real estate sector. So that was down minus 2.29. The basic materials have not been doing well recently, though the precious metals did well overall. Economic sensitive, whether it's a copper, and they tend to be connected with home building, aluminum, copper, and steel, and so on. And those have been kind of not doing so well. It has a declining slope since the May, and we can see that here with XLB down 0.46. Industrials have also been down, downward bound since its double peak in May. So two highs, once in towards early April and once towards May. So from that 126 level has pulled back to the 120. It's kind of hovering around that 120, 121 level. This in many ways is a bit of a concern. If it's a double top, then a break below 120 goes to 114. So that's something to watch. Industrials have been lagging. So down minus 0.53. The healthcare is also a sector that didn't do very well, which is where pharmas and the biotechs are. They got a bit of a pullback. There's been a lot of call it pressure from the government for high drug prices. In particular, Eli Lilly and Novo Nordisk have been in the news for their extremely high diabetes drug prices, and that has kind of brought some pressure down in terms of government putting pressure on the pharmas to cut prices on these blockbuster diabetes drugs. And then energy sector has not been able to find a bid. There was a bit of a counter-trend move from below 87 towards the 92 level. Got a bit of a pullback, down minus 1.17% for this week. So XLE downward sloping. So did want to talk about a chart that we have shared in our videos in the past. In particular, Tesla. We had indicated that Tesla was poised for an ascending triangle breakout. This is a beautiful ascending triangle with the resistance level at the horizontal at 198, 199, and then the lows had been ever since the the pullback in April, and then it had touched 138 just before earnings, and then from there it has shot up post earnings. And there's been quite a strong anticipation with Tesla's robotaxi launch expected on August 8th, as Elon Musk has kind of promised. There's also their second quarter sales was strong. Market was expecting maybe 400,000 or so cars, electric vehicles. They met over 444,000. So that has been strong, much stronger than expected. Elon Musk has been, and then the key part is their energy. They have a big part of the energy that they from their solar that was especially with all the power that they generate, being able to take that power and then be able to distribute it out, save the power and distribute it out. They've been doing quite really strong, showing very high profit margins on the energy business. So that in many ways has also helped the stock. And then the anticipation of the robotaxi launch. Tesla in general tends to have upward move in anticipation of earnings, and especially the month of July is very strong for auto stocks, and Tesla as a result have been beneficiary. And we can see this just absolutely stunning break. The last pullback was in mid-June to 167. From 167, it touched 252 this week. So that's, you're talking about close to 52 plus 33. That's almost 85 points. So a climb of 85 points just happening in a span of maybe 3 or 4 weeks, and this is quite a strong move. And in this entire move, you could say that the discretionary, because Tesla is the core component, has been directly benefited from it. So from here, we're going to talk about cryptos. In particular, there has been the whole Mt. Gox, which is defunct Japanese crypto exchange that went bankrupt because of a massive hack that happened 10 years ago in 2014. About 150,000 creditors had their coins attached to the exchange, and finally they were able to recover those coins and pay them back. So there's a payment redemption going to happen this month in July, and there's expected fear. This news hit the market on June 24th, and since then cryptos have been downward sloping. But in particular, we're going to show you in the hourly chart that the market got hit with some redemptions and some selling going on the July 4th weekday holiday, and then the following day after that, 2 consecutive days, very strong active selling happened in the Japanese market hours, which meant it originated out of Japan. So that's one part. There are 2 parts to the payment redemption. One is the Bitcoin itself, BTC, and then also another instrument much lower in price at 150 at the price of Bitcoin as Bitcoin Cash, BCH. Both are impacted because there's about 143,000 coins for Bitcoin Cash and 150,000 coins for Bitcoin that will be paid out. In particular, for the Bitcoin Cash, the liquidity in terms of daily trading volume to the amount of redemption is significantly higher. You're talking about a factor of 24 to 25% of the volume being impacted by the redemption on Bitcoin Cash, not as much on the Bitcoin itself. You're talking about 150,000 coins at roughly 60,000. It's 9 billion of volume, or 9 billion of Bitcoin that will be redeemed, but taking a daily volume, that's only 6%. So there was an article about that really saying that from this analyst in particular, not to expect as much of a movement. But what really happened was, yes, there was quite a bit of movement. And then there was also a Barron's article. Often Barron's does put out these bearish articles saying that, the fact that Bitcoin has fallen to 56, there could be further downside. And we're going to talk about where that bearish view could be coming from, looking at the daily chart, for example. And then we have, if you look at, YouTube and just did a plain search on Bitcoin, you can see that there was just ton of videos recently in the last few hours talking about the crypto crash, talking about the dump going on and the end of Bitcoin. So some pretty negative news on Bitcoin. That said, there has been very positive thoughts on Bitcoin by a perma bull, Cathie Wood. Her projections have recently increased up to 2.3 million target on Bitcoin by 2030. She originally had a target closer to 1.5 that she raised to 2.3. This was towards late April. And another perma bull who is expecting a sharp rebound is Tom Lee. Tom Lee was in CNBC earlier this week. He was, of course, also extremely bullish on S&P 500. He recently made bold claims about an S&P 500 target 3 times from where it is currently at about 15,000 by 2030. He talks about the demographics, the Gen Z crowd, as they get to the 30 to 40 age group, and the millennials, they will be doing a lot of the investments on houses, on their respective economic wealth, and that will help the stock market, especially with the AI related gains keep going higher. So he had made a bold prediction of 5,500 on S&P 500. That was when S&P was at 52, and that was the beginning of the month. And he was there, of course, to celebrate that. Yes, he was exactly correct on that. And his other, towards the end, when asked about Joe Kernan, the CNBC talk show host, asked him about Bitcoin, he put his foot down and he says that he still expects a move to 150,000 as his target on BTC by end of the year. And he feels that the redemption causing the bit of overhang for the month of July should pass, and then there shouldn't be blue skies. And he said that bulk of the Bitcoin gains happen over 10 trading days in a year, and that could be coming up this summer. And he easily sees a breakout above the previous highs at 73 and move towards the 150 by end of the year. That's his target, and he remains bullish. So that's the perma bull, both Cathie Wood and Tom Lee, with high upside on Bitcoin. But with that, let's just look at the chart. Looking at the hourly chart, we can clearly see the big bearish candles here with heavy volume sell-off, where Bitcoin in a span of a couple of hours fell from 60.4K to 57.9K. This happened right at, and this is on the GMT time, because Bitcoin trades 24/7 and they track the times along the GMT times. Around right past midnight, which is about 8 p.m. on Eastern time zone, Eastern Daylight Time, this sell-off happened. So that was talking about 13 hours ahead for Japan. 8 p.m. In Eastern Daylight Time was 9 a.m. at Japanese to open up trading. So these two hourly candles, when 60.4 dropped to 57.9 sharply with heavy volume, was primarily out of Japan causing the drop. And then the following day, it tried to get a bit of a recovery back towards the declining 20-hour moving average. This is a period in you can see it's an hourly chart. Every candle is 60 minutes, an hour. So it did try to go test that declining 20-period moving average. But then again, as soon as the trading came in, and late evening on the 4th in US, which is morning of Japanese trading time, from 58.7 it trails to 53.5. So that was a steady, almost a 5,200 drop, 5.2K drop in the Bitcoin price. Since then, all of trading today, the US markets opened. There's been bullish reversal buying going on, and we could see that from 53.5, which was early morning US hours or late night yesterday, it has resumed and come back to closing near 56.5K. So kind of got a $3,000 upside reversal on the Bitcoin. So that's something to watch, but we can see clearly from the accumulation distribution, this was the drop going on that got AD down here, and then from there, this has been steady buying throughout the day, AD back towards the highs. So that means that market is perhaps expecting that this to be a near-term hiccup and then perhaps a resumption. Now, that's the hourly chart. If you look at the daily chart of BTC, this is a classic M-shaped double top. Now, yes, there is kind of a quadruple top with respect to testing 72 to 73,000 4 times. You can see it here at towards early March when BTC hit its high at 73.8, then 72.8 in April, pull back to 56.5 by the late April. This was an overall market pullback in April. From there, went back to 72, climbed to another test of 72, 71.9 in June. So each month, basically March, April, May, and June, Bitcoin came to testing 70 to 73, but it never broke out. But eventually, it's kind of an M shape. If that M shape pans out, then this could turn out to be a breakdown that measures down to 39.2 thousand. Now, 39,200, that's the bearish scenario. That's what bears would like to happen. But if you look at a little longer term chart, which is a weekly chart of Bitcoin, BTC actually has a beautiful cup and handle. The cup was already formed from the 69K that it had hit in 2021 peak, pulled back to 15.4, 15.5 towards late November or late October, early November in 2022, climbed to 73.8. We saw in March. Beautiful handle forming. You can see a declining channel, but the declining channel being shallow. This test that we had this week actually reversed from the bottom of the channel. So it didn't break below it, which is a nice trending handle and a breakout here. If you break from 15.5 to 73.8, take the difference and add it to 73.8, that's 132,100 is where that expected target is. So closer towards that 150K target that Tom Lee has. So something to watch. Would this have been an awesome buying opportunity for Bitcoin? And there were options like there are 11 ETFs in BTC, whether it's the largest Grayscale, GBTC, Fidelity has an FBTC, and there's a bunch of other Bitcoin ETFs. Or for the aggressive ones, you could have looked at BitX, BITX, that also pays over 30% dividend, and on a monthly basis, 85 cents per share dividend every month, and it moves twice X the rate of Bitcoin. So if you're talking about a move from like 56,000 towards the 132, that's an easy more than an easy double, and that could mean that BITX from levels near 28, very close today, could go to if you're going to get 2x move in BTC, that's going to be a 4x move in BITX because of it's twice x the Bitcoin, and that would mean that it could easily go to 100 plus on a BITX. So that could be a very strong move for the aggressive traders of Bitcoin looking for a strong investment. Now, one thing that we posted in the blog is why we remain bullish on Bitcoin's outcome is the largest miner, Mara. Mara, we can see, has a beautiful ascending triangle, just like what we had seen in the Tesla chart. This is also a beautiful ascending triangle. There is a horizontal baseline resistance at 22. It kind of crossed that recently at 22.98 versus 22.86 from May, but the lows, as you can see, are ascending: 14.18, 15.63, 16, 17.6, 18.37, and this low from today, when we saw this overnight selling over the holidays at Japan, it had a higher low. Mara had 19.42 above the lows from July 24th, when the Mt. Gox liquidation news first hit the market. So we can see that this is a positive trend, and if the cryptos resume their climb next week, we could very well see Mara break 22, and the target we have there is 31.5, 31.5, closer towards the December 2023 highs at 31.3. So that's where we see Mara potentially headed, and the fact that Mara is showing an ascending triangle indicates that smart money thinks that Bitcoin, this sell-off that we're getting in July, is a buying opportunity, and the miners could be beneficiary of this climb going higher. Now, part of why the miners like Mara and Riot have been kind of downward trending since the February highs was the halving event that happened in April. Halving means they get less number of Bitcoins per block of Bitcoins that are mined, and that got cut in half from 6.25 to 3.125, and that's kind of brought overall their rewards for mining, and hence the expectation of the market was that the crypto miners would be kind of having lower margins. But Mara, in anticipation of this, kind of added their mining compute power over multiple areas. They kind of grew and expanded, and they have over 1.5 billion in net cash in the balance sheet and their cryptos that they have not sold yet. So solid balance sheet, company that's got their hash rate has actually done outstandingly well, where people thought that's their manufacturing capacity. So their hash rate being strong, their their earnings in May was actually quite strong year over year, showing double-digit or triple-digit growth. So this could actually be a good, an indicator of upside in Bitcoin coming in the next near future. So I want to talk about the 10-year yield next. This is something that is a barometer of where the economy and the market is headed. This is the 10-year treasury, and we know that there was a breakout of a 4.3 that we had talked about that measured closer to 4.9. It didn't quite get there, but there is an ascending time channel. If you take the highs and you join it, and then parallelly do the same kind of channel to the joining the lows, we can see that it touched 4.73, pulled back to the bottom of the channel near 4.2. It tested 4.18 recently, and went up to 4.49 or 4.5, pulled back again. In many ways, this is a beautiful inverse head and shoulder forming on the 10-year yield, which means the left shoulder is to 42.77, back to the neckline 44.79, back to the head at 41.88, back to the neckline again at 44.93. And this day today, we got with the pullback in 10-year yields, 42.71. Now, the reason this pullback happened in yields this week was the weaker economic data. Both the ISM services and manufacturing were in the 48.5, 48.3 level, indicating slowing economy, and the job data with the 4.1% unemployment. So market thinks that there's going to be a dovish Fed moving forward, maybe with a rate cut coming in, the first one in September, and then maybe another one later in the year. And as a result, the 10-year yield. But if it turns out that next week Powell, he's got the Senate and Congress hearing, is not as dovish as people are thinking, this could perhaps have an upside breakout and move past the 4.49 towards, if you look at the measured target from 41.88 to 44.93, that's almost a 3-point add to 44.93, that goes to 4.79, 4.8. So there's a possibility that we could be back towards the top of the channel if we get not as a dovish Fed, but a hawkish Powell next week. And if the CPI and PPI aren't as tame and downward declining as the market thinks. So that's something to look at. And now with respect to NASDAQ 100, which has been an outstanding mover for the entire pullback from the October lows to the movement that we've seen here, we can see that when we do seasonality charts on QQQ, and in this case, you're looking at almost a 16-year seasonality, 100%, as in all 16 years, QQQ has been up every year. So that's the percentage of months in which QQQ closed higher than where it opened from the previous month. So every month in the month of July for the last 16 years, QQQ has moved up. That's why you see that at 100. So seasonality-wise, July is a very strong month for QQQ and sets up for upside in QQQ. And if you look at the across the months, and this is again over the 16-year period, the biggest movement is in the month of July, the strongest month at 4.8%. You can see that the others are a lot lower. The next closest month is the month of November at 3.3, and everything else is a lot lower. So July is the strongest month. November, in fact, does have strong trend at 80% of these 16 years. It has seen, QQQ close higher, but, July by far is the strongest one. So if you look at the chart of QQQ and we look at its weekly chart, here we see a beautiful ascending channel as well, joining the highs and the lows. And it has been climbing from that low we saw back at October of 2022 near 251, rising higher highs, higher lows. So 257, 282, 349, 412. And recently now we are at 496. So in this rising higher highs, the top of the channel is very close to 500. And so QQQ is at that top of the channel and having tested the bottom of the channel near 412 very recently in April. So in a span of April to July into 3 months, it's already gone from the bottom of the channel to the top. So that shows steady, strong strength. Now, if you look at the weekly chart from a cup and handle pattern, we can see beautiful cup between 401 to 251 back to 385, and then a shallow pullback from 385 to 349. And since then, it's been climbing. That measured target, so from 251.18 to 385.32, that's 134.14 points. At 134.14 to 385 to 32 is 519.46. That's closer to 520. So that's our target. We've been saying about this for a while in QQQ, and we are expecting it to head there. We're almost there. We're at 496, almost 500 to 520, or 496 to 520. You're almost like 24 points. That's less than 5% upside left for QQQ to get there, and good chance we might get there in the next couple of weeks. Something to think about. However, what we do want to observe is the divergence in terms of the momentum in the market. While the price has been climbing higher highs, the NASDAQ 100 stocks, and there are 100 stocks in the NASDAQ 100, percentage of stocks that are above the 200-day moving average, it usually indicates bullish trends. 200 moving is almost like a line in the sand. When things are above the 200, they have a bullish trend, and they're below the 200, they tend to have a bearish trend. But in here, the percentage of stocks that hit 88% above the 200-day moving average in the December when the market QQQ had pulled up quite a bit. Since then, it has been putting in lower highs, indicating declining strength in the market, declining strength in the bullish percentage of stocks in the market. So recently it had touched 68 earlier in the week, and today closed at 63. So with this declining, this indicates that the market is getting weaker and weaker in terms of breadth, in terms of bullish strength. And that also is seen in the BPNDX, which is from looking at the bullish percent index. This is more from the point and figure charts. When you look at the number of NASDAQ 100 stocks that are bullish looking point and figure charts, that's at 60, but it's much lower from the peak it had seen at December at 90. So here also we can see declining trend of lower highs, 90 to 82, coming down to 62 in May, and now at 61 and at 60 close today. That is also an indication of declining strength in the market. So fewer and fewer stocks are leading the market higher. And as we know that the Magnificent Five, the $1 trillion, the $2 to $3 trillion plus stocks are all primarily the the stocks with their weights helping QQQ keep climbing higher. And finally, there's another index called the Summation Index. And this is an extremely shocking view that while NASDAQ is, QQQ in particular, is at all-time highs at 496, the Summation Index is actually negative RSI and it's at negative value. This is the advance minus declines. So in general, there is more declining stocks than there are advancing stocks in the NASDAQ index. And this is the NASDAQ, overall NASDAQ McClellan Summation Index at minus 431. So that means that this typically happens when the market is oversold, but this is not an oversold market. This is an overbought market. So it's not healthy. What we are seeing here is a NASDAQ Summation Index with an RSI at 20, deeply oversold with from terms of breadth, in terms of advanced decline ratios, yet the market at all-time highs, primarily by a few stocks leading it higher. Finally, an indication of that lack of breadth is evident in the small cap index. Now, this is one part that Tom Lee was not correct so far. His prediction for small cap was to have an outstanding year. In particular, he's often talked about their valuation, while his valuation justification for S&P hitting 5,800, by the way, is that he expects earnings in 2015 for the S&P 500 stocks in the range of $285. So $285 with a, anywhere from 20 to 22 as the P by E ratio. You measure anything in the 57 to 5,800 is where he's expecting the S&P 500 to head it. Now, his projection on the small cap the small caps or the Russell 1000 stocks has been a 50% climb this year. And so far, that's not quite panned out. We can notice at the beginning of the year, IWM was just below 200 in the high 198 level. It has been primarily in the 198 again at 199, 198 over the last several days. Yes, in some ways, the weekly chart is showing a bullish pennant. Why? Because there's been a bullish climb from 160 to 211. Since then, you can see a line to the declining tops and a line to the ascending bottoms. So that's a pennant. So that, if it has a breakout, and I think the primary factor, the economic reason of this breakout could be finally a rate cut and a very dovish Fed, or the economy to a point is indicated by the Fed that they will be behind, helping with interest rate cuts, and that definitely is a welcome sign for small caps. And their valuations have been hurting quite badly. They've been at significantly lower valuation that they've been for over a decade or more than that. And they're currently selling at a P by E ratio closer to 10 or 11, when S&P 500 broadly is selling at a P by E of 20 to 22. So this has been one prediction that Tom Lee has not quite panned out for him, where he had a 50% rise in small caps, which would mean that from a 198, a 50% rise would take it closer to the 300 level of IWM, if that's what is the case for his upside target for the year. So that's one part that he has lacked. But other than that, his he's been quite strongly correct on the S&P 500. He doesn't predict as much about the QQQ. His primary predictions are on small cap having a 50% upside, S&P hitting a 55 in June, which exactly panned out. His next level of 57 to 58 is also very likely in S&P's, the way it's an upward trajectory. By the time QQQ gets to 520, very good chance. In S&P already closed near 57, like 55.70, 55.80. So another 120 points points to get it to 57 is quite likely in the next few weeks. And earnings is coming up starting next week with the banks and then the technology earnings, and that could perhaps the upside to get it there. So something for the small caps to be looking at is, are we going to get the breakout, or is this, either way, pennants tend to break either up or down. It's kind of a volatility squeeze. It gets narrower and narrower. We're almost at the apex of that pennant. So within the next couple of weeks, we should see a resolution one way or the other. Maybe next week we'll see the resolution, depending on where Powell is with his Senate hearing, and then the CPI and PPI data. If CPI and PPI, he's been waiting for multiple data points of weak inflation. So if next week's data are cooling down, it might be enough of a reason for Powell to be dovish to start bringing rates down. But there is a bit of a contradictory nature on that, given at the 10-year yield chart showing a potential upside. If the 10-year yield goes up to 4.8, 4.9, this could actually not be good for small caps. This could actually have a negative impact, and small caps could perhaps, kind of break down towards the low 190s. So something for us to look at. And with that, it's a pleasure talking to all of you. Good luck. Happy trading next week. Thank you.